Will we or won't we fall into recession in the next 18 months? A new survey of corporate executives, business owners, and private equity investors found only 3%, say the answer is no. Michael Collender is the Stifel head of retail, consumer, and diversified industrials investment banking. He joins us now with more on this study. Good to see you, sir. That was a shocking and, well, rather frightening number. How did it surprise you? And if you could break down when the majority of those believe we will hit a recession.
Sure. Great to see you, and thanks for having me. Over the past months, I've been in regular dialogue with CEOs, private equity executives, and the like. And we've been hearing that consistently, that they believe that we're either in a recession or heading into one very shortly. So we chose to do our annual survey again and found those stats to be incredibly true. 97% believe either we're in a recession today, and the vast majority believe we'll be in recession over the next 6 to 18 months.
You know, Michael, it's interesting here because only 3%, like you said, think a recession will be avoided. Yet the biggest concern here when it comes to a threat to their business, 64% say the labor constraints versus inflation and recession. What's your reaction to that?
Yeah, we're hearing that all the time, that CEOs are struggling to find significant enough levels of labor at attractive enough pricing. So pricing and cost of labor has moved up dramatically. But not far behind labor is inflation, recession, and supply chain issues. So those are the four big issues we found in our survey. And that's consistent with what we were hearing anecdotally over the past several months when speaking with CEOs.
That issue that Chana just brought up, is it particularly regarding a skills gap, or what's the difficulty they're having in finding labor?
Well, it's not necessarily just a skills gap, but we have some of that. It's just capacity. We've ratcheted back so quickly, and now we're pushing up labor rates dramatically. But we're also finding, which is really telling, and we've been hearing this while speaking to executives, is despite how far the cost of labor has moved up, those earning under $100,000 a year are not keeping up with the rate of inflation. So companies that are servicing a consumer that's in the $75,000 and below are actually more struggling and are seeing contraction of their business, given the fact that the wage rate for their core customers not kept up with the rate of inflation.
Yeah, Michael, also 2/3 are increasing their investment into technology and automation to help mitigate some of those labor shortages. To what extent do you see this potentially helping address this challenge?
Yeah, actually, what we found was two interesting things. Companies are spending capital on M&A and on technology to offset rising wage inflation. So they're willing to deploy CapEx, both for mergers, acquisitions, along with technology investment as a way of reducing their need for headcount. On the merger and acquisition side, we're seeing both vertical integration and horizontal integration, where they're buying capacity, they're buying supply chain, they're going back further into the supply chain, or they're buying competitors so they can leverage a fixed overhead structure.